Tesla have recently provided another set of record deliveries. Today we're going to unpack the numbers surrounding TSLA's recent announcement. We'll talk about how Tesla is currently positioned within the broader electric vehicle sector, and then make sure you stay until the end, because we're going to talk about what Tesla's delivery numbers mean for lithium stocks. And we've had a bit of an insight with some recent announcements from some of these leading lithium companies, which we'll be unpacking later on in the video. It's a fascinating time. I'm sure everybody by now is familiar with the Tesla story, but so far they continue to deliver on a deliveries number, and quarter in and quarter out, they seem to surpass expectations. We know that Tesla serves as a bellwether for the broader EV sector, and on the same type of dynamic, it also provides a bit of an insight into future demand for many of these EV battery material resource providers. Having a look at some of these numbers here, we can see that Tesla themselves, they delivered 310,000 vehicles this quarter, just eked out a beat ahead of consensus estimates, which was around that 309,000 delivery mark. When we're just having a look a little bit further down below the line, we can see there that the Model 3 and Y, 95% of the deliveries, and then of course the balance was made up of the Model S and X's. We know that Q1 as well is a seasonally weaker quarter. And along with that, there's been some industry-wide tailwinds, which we'll be unpacking later on in the video. I think what's been fascinating about the Tesla story is that Elon Musk has continuously reiterated that this is not a demand issue. Tesla has no problems with demand. At this moment, their issues are with supply and their capacity constrained, and which of course, this is a fantastic place to be. And they're of course trying to add on as much capacity as they can. We saw that Giga Berlin came online recently. So it's going to be fascinating to see where the TSLA journey heads from here. And so then when we're thinking about the current backdrop, as we know, the macroeconomic environment that we're currently in, it's not an easy one, and every company around the world is navigating it as best as they can see fit. Elon Musk highlighted that this was a fantastic quarter. They're really happy with how it played out. But of course, he highlighted that there was supply chain interruptions, and that it was made difficult as well with China's virus policy because of course their Shanghai factory, there was some closures in terms of that. So that affected their ability to produce. However, despite the fact that we're in an inflationary period, there's of course still uncertainties surrounding everything going on in Europe, and there has been rising input costs, which everybody is familiar with. I'm sure that most people have seen the rapid uplift in terms of the underlying lithium commodity price too. Despite all of these, Tesla was still able to provide record deliveries, and this is made even more remarkable when we take that step back and have a think about the current backdrop that many of these automotive manufacturers are trying to play into. If you look at leading players like General Motors, whose vehicle sales were down by 20%, if we look at other companies like Ford, Toyota, and then even look at the broader macro US vehicle sales, which was down, we know that the semiconductor chip shortage has not disappeared yet. It's still here. But despite all of this, Tesla was still able to provide a record. It is quite remarkable, and it speaks to the agility and the different type of approach and lens that Tesla takes compared to many of the incumbent and legacy automotive manufacturers. I'm keen to know your thoughts on it all as well too, so drop in a comment below what you made of Tesla's recent delivery numbers, and where do you think the TSLA story heads from here moving forward? And before we go further as well, that standard disclaimer, I'm just a bloke on the internet who loves talking about the markets, obviously not a financial advisor, nothing we discuss is financial advice. Hopefully, however, it's an interesting starting spot for you to go away and do your own research from. And so of course we know that Tesla provides their vehicle production and delivery numbers prior to ultimately providing their quarterly results, but they've given us a date now, April 20th, so over the next couple of weeks we'll get some more insights into the financials and how everything's playing out on that front. There are a few key takeaways that we could take from some of these recent numbers with deliveries, and as well as the current setting that Tesla's operating in, that gives a bit of an insight into what we could expect potentially moving forward. As we know, there are actually some supporting tailwinds on the margin side. There is the expectation that there's likely to be lower expenses in comparison to the past period due to some one-time expenses on that front. Of course, for Tesla, some of the key high-level metrics that investors and analysts are always looking for is how is it growing Q on Q, but then also how are the margins going. Tesla's obviously working towards that 20% operating margin, having that two handle in front of it, and we're going to be watching for continued improvements in the operating margin side. We know that Tesla has been prioritizing the FSD clients, and so they'll be able to get a higher take rate in terms of the $12,000 FSD, which should ultimately start to flow through to revenue as well as they prioritize this. And even though there have been rising input costs, which everyone's familiar with in this macroeconomic landscape, Tesla looks like it's uniquely positioned compared to many of these other players as well in the space to be able to potentially offset these rising material costs. We know that Tesla have been raising prices quite proactively over this past period, and we're going to start to see these price rises be realized in this upcoming quarterly, and then of course the consequent quarterlies from here. And what's fascinating about that as well is so far, as Elon Musk mentioned, it doesn't look like Tesla's issue is with demand. So far, consumers have been able to digest these price rises. And so even though there are inflationary and rising input costs, Tesla looks like it will be able to pass these on to consumers, which is going to be quite an interesting dynamic to see continue to play out. And so then just thinking about that pathway up ahead, there really are a couple of key highlights looking forward for Tesla's story. Of course, we know that Giga Berlin is now being commissioned and it's starting to come online. We saw Elon Musk dancing at the opening for that, but that will then provide the first gigafactory that they have in Europe. And of course, this is one of the fastest growing EV markets in the world too. Of course, growing demand, we've talked about that. It's going to be fascinating to see how that plays out. And as well as the regulatory landscape in the different regions around the world. We know that China and Europe have been fast growing for EV, very supportive as well. But it's going to be interesting to see other nations and other regions if we start to see some more incentives and subsidies as this EV revolution really starts to pick up pace, particularly with a focus on decarbonisation that only continues to grow as well. As well as that too, as mentioned earlier, there's really two key focuses that analysts and investors really look for with Tesla. Top line growth, but then they also want to see improvement in margins. And so this over the upcoming quarters is going to take more and more attention. Tesla does look like it's on track if growth continues on the same trajectory to deliver 1.5 million deliveries and potentially above that over this year. So that's where a lot of eyes are going to go. But the Tesla story still does look like it's in its infancy, as well as the broader electric vehicle transition. Of course, we see that it's starting to pick up pace, but penetration as a proportion of total sales for EVs is still it's under 10%. And so the opportunity and the roadmap ahead for companies that are successful in this space is going to be quite a fascinating one to watch. And so then all of that leads us to the lithium market. As we know, Tesla does not operate in a vacuum. It's not just one company operating in a silo, but it's part of a broader ecosystem. And obviously increasing demand for electric vehicles can and will have potential implications further upstream as well. As we know, as more electric vehicles come online and are demanded by consumers, the raw materials and resources that help to facilitate that transition are going to grow in demand as well. This past period, we've done a range of different videos looking into the supply and demand dynamics in the lithium market, as well as for a range of other EV battery materials. So we'll leave links to those up above that you can check out after this one if you are interested. But I thought it would be an interesting time for us to reflect on some recent announcements and pieces of news flow from some of the leading ASX Lithium stocks. Each of these are significant lithium producers in their own right, but each of them have a slightly unique narrative, providing some insights and understanding about the state of the lithium market in its current form. Before we dive into these different pieces of news, if you have enjoyed the video, don't forget to hit the like button. We make a new video each and every day, so if you haven't yet, make sure you've subscribed, turn your bell notifications on, and you won't miss any of our daily episodes. But with that, first and foremost, Allkem. They provided a bit of a pricing update recently. This actually really catalyzed some excitement in the broader lithium cohort. As we can see here, they provided a pricing update both for carbonate in terms of the downstream chemical, but also for spodumene concentrate too. And really just having a look at the numbers here, you get a bit of an insight into the growing demand and the uplift as well, as we've seen the lithium price continue to grow week in and week out over this past period. When looking at the lithium carbonate indicative pricing, we can see here for the June quarter, it's expected to be approximately around US $35,000 for around 3,500 tons. What's fascinating about that, the preliminary March quarter sales price, and these are all still preliminary indicative pricing, so haven't been finalized yet, was approximately around US $27,000 a ton, which was already higher than guidance. So it's continuously getting re-rated and is actually higher than initially was guided for. But then here for the June quarter, that's going to be growing once again to $35,000 per ton. And the same types of trends and trajectory were playing out on the spodumene side. In terms of concentrate, March quarter, which did include some tons that were delayed from the December quarter, was below $2,500 US a ton. But for this quarter in June, there's indicative advanced discussions here for potentially spodumene concentrate pricing of around $5,000 for SC6, which is absolutely incredible. That's obviously more than 100% growth in terms of the March quarter. And this just gives an insight into how much demand there is out there at the moment for lithium, and the fact that companies who are looking to produce are willing to pay for this lithium to get their hands onto it, because supply in its current form can't come online fast enough yet. And so then building on that as well, Allkem as well provided a capacity upgrade. They provided some indications at their Sal de Vida project. Initially there was going to be a stage 1 and then potentially 2 and 3 further down the line is now going to have an increase in total plant capacity to 40,000 tons per annum of LCE, lithium carbonate equivalent, but they're consolidating stage 2 and 3 into a single expansion. Obviously, having stage 2 and 3 split out, it de-risks the project. It allows you to potentially bring more capacity online as demand starts to rise to those levels. But it looks like from all indications, potentially there's the indication that demand is going to be in the here and now and sooner rather than previously estimated. So as a result of that, they're consolidating the stages up and lifting total plant capacity as well. And then Pilbara Minerals, ASX PLS, is another company in the space that's really been a leading bellwether for many of the ASX Lithium stocks over this past period. Indication here that a scoping study supports the potential in value add beyond just spodumene concentrates, looking further downstream. And this was with a fascinating potential JV with Calix Limited, another ASX company under CXL. This, of course, is building on top of the work that they're investigating and exploring currently for a lithium hydroxide facility with leading global player POSCO. And this theme that we're seeing play out here is a lot of these players in Australia as well as around the world, they don't want to just be extracting the raw resource. They want to be looking further downstream, capturing more of that value. And there is quite a defined focus from many of these players to see how that fast and how quickly they can bring this capacity further downstream online and capture more of that margin. And we're seeing that with Pilbara too. And then MinRes. Mineral Resources provided a production update recently for 2 of those projects. First and foremost, Wodgina. This is a project that they were initially going to be resuming production in, bringing on production with their trains at different stages, but they've accelerated the resumption of production from train 2. And this is feeding into the demand that they're currently seeing. Train 1 was expected to have concentrate. It's now expected in May 2022. And they're now looking to bring Train 2 online, which is going to be another 250,000 tonnes of capacity earlier in July. This is, of course, speaking to the significant demand that they can see. Wodgina is going to be a restart. Obviously, it was into care and maintenance, but it's going to be fascinating to see how this plays out and then ultimately when Train 3 eventually comes online. Because as you can see here, each train has a nameplate capacity of up to 250,000 dry metric tonnes of spodumene concentrate. Then Mount Marion as well, there's an immediate uplift to be seen here. This is the current project that's in production at the moment. They're expected to result in Mount Marion spodumene concentrate production increasing immediately. So there's no waiting around here, from 450,000 TPA to 600,000 tonne per annum. And this is going to be online as soon as April 2022. And then ultimately what's fascinating is there's a second stage of expansion, and they envisage that eventually installed plant capacity to run at a rate of 900,000 tonnes per annum by the end of calendar year 2022. So these are some significant uplifts in terms of throughput, and it's not like they're waiting to see over the next few years. It's in the here and now, and this is trying to feed into the elevated prices, obviously, as well as the significant demand that we're starting to see, as has been evidenced not only in Tesla's deliveries, but by the bigger focus globally around the world in terms of this electric vehicle transition. And I think all of that was conceptualized with the Mineral Resources Managing Director, Chris Allison, providing a bit of an insight with this lithium business update that we just heard from. For some time now, the world has seen extraordinary demand for lithium, driven by the strength of the electric vehicle market. This demand has resulted in a substantial increase in lithium prices, with pricing expected to remain strong for the rest of this decade. There's been a lot of calls about, is this the commodity super cycle? How significant is this decarbonisation trend really led by the electric vehicle transition going to be? Obviously, there's divergent opinions on this. Everybody's going to sit on one end of the spectrum about where we head, but there can be no debating that this transition is really starting to pick up pace, and the lithium market is attracting a lot of attention in the here and now. It's going to be fascinating to see where things head. We've got other videos on the channel that we'll leave links to up above that you can check out after this one. Drop in a comment, let us know your thoughts on it all. A reminder, I'm obviously not a financial advisor, it's just a general discussion. Hopefully it's an interesting starting spot, however, for you to do your own research from. Thank you for joining us. For now, stay well and happy investing.